Never bet against the American consumer, because that's kind of been what's driving this economy for a very long time.
That's not only the American consumer, it's also American manufacturing.
With the Fed starting to cut rates now, we've seen this stock skyrocket.
The most impressive thing about this company is the fact that they have increased dividends for 57 years in a row.
If Costco ever sells off, I'll refinance my house and buy a ton of shares.
All of these REITs are in densely populated markets. I think that's the key, and that's something I learned as a developer. Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward. Nick, it's good to see you today.
Yeah, good to see you, Brad. And I think this is going to be the episode that gets us past that 10K subscriber milestone. So, especially happy to be here today. We've been talking about that for a while now, and I think we're finally going to hit it.
Great. It's great to hear those numbers. And also, we get a lot of comments in our videos, which is great. It keeps us going with new content. And some of our audience has asked us to cover retailers, which of course is a subject, one of my favorite property sectors and really asset classes. So excited to talk about some retail today.
Yeah, well, I like it. I don't invest in a lot of retail companies myself, but I understand why so many people like these names. One, these are huge brand names. Everybody's heard of these companies. Many of them have been around for over 100 years. And two, Warren Buffett's been saying it for decades, never bet against America. And so much of that comes down to what he's really saying is never bet against the American consumer, because that's kind of been what's driving this economy for a very long time. You might be able to speak to this. I know the Trump administration is trying to change that. They would love it to have more manufacturing base, to produce more things, not being a kind of consumer service-driven economy. But for years, the American consumer has held up strong throughout a lot of economic volatility, and I think that's going to be the case moving forward. That's what the macro data shows. So today we'll talk about a handful of stocks that should benefit from that trend moving forward.
Yeah, and it's not only the American consumer, it's also American manufacturing. And President Trump has also made that a big part of his agenda, is buy USA, companies that manufacture here in the USA. But of course, we still get a lot of manufacturing outside of the US as well. But this topic's really important for me and really relevant for me. I'm the father of 5 kids, 4 girls. And when you have 4 girls, Nick, yep, you know a thing or two about shopping. I think I've been to many of these stores. There's probably not a retailer that I haven't spent money in, unfortunately. But anyway, I definitely know all about shopping. And, we say sometimes, you shop till you drop. And, certainly understand, how the retailer thinks, speaking of it from a consumer perspective.
Well, and you've been a landlord too, right? So I think you're going to touch on that today. Do you want to touch on that now? Do you want to get into that later when we talk about REITs? I know you have experience, obviously, spending money in these stores, but also owning the land and the real estate that makes them work.
Yeah, let's start with you, Nick, because let's talk about the rent checks, right? Because a lot of these retailers are the companies that generate the rent checks for these real estate investment trusts. So let's start with you. I know you've got some pretty interesting retail picks here today.
Yeah, Brad asked me to find some retailers that I liked. And like I said, this is hard for me because there's always seems to be a problem with the retailers. They're either, 1, I don't like the valuation. 2, I worry about the strength of the moat. Or 3, the margin profile isn't where I like it to be. Oftentimes, these retailers, there's not a lot of overhead room for them. So they operate, fairly thin margins. It's been working for a long time, but then the e-commerce trend has kind of disrupted that over the past decade or so. So I'm going to talk about some that I do like and some that I would avoid and why that is. So we'll start off with a good one here. Brad actually mentioned this to me this morning, and I totally agree with him. Kroger, about as boring as it comes. Massive grocery store chain operator. I'm looking at it here. They've got a $43 billion market cap. 17 out of the last 20 years, positive EPS growth. So very consistent. Positive EPS growth in both 2008 and 2009. So goes to show, and also in 2020, looking at the numbers here. So during the last, major recessions that we had, obviously people have to buy groceries. We all have to eat. we've talked about that when we talk about companies like Coca-Cola, PepsiCo, et cetera, these huge dividend aristocrats that we love so much. Well, Kroger sells these goods, and e-commerce has not disrupted the grocery store space. Amazon spent, I think, $10 billion on Whole Foods Market probably about 7, 8 years ago. And I don't think that really worked out like they hoped it would. I mean, they still own the company. They still, use the franchise for a drop-off point for returns for your Amazon orders, et cetera. But people are not ordering food to their house en masse. It's too expensive. It needs refrigeration, et cetera. So Kroger is a great company. Brad mentioned to me that it's pulled back some, and he's right. At the beginning of the year, this company is trading around 16 times earnings, which was well above its long-term average in like the 13 times range. However, the stock has pulled back throughout the year and is trading for about 13, 12 times forward right now. So fairly valued, I think. Great company, 2.1% dividend yield, very consistent dividend growth. The reason that I don't own this company myself, I have in the past a long time ago, the margins are just so thin. In a grocery store, you don't make, you got to buy the goods, you sell them, you only get a little bit of markup. So it doesn't fit my personal portfolio very well, but I do acknowledge it's a very high quality dividend stock, very reliable dividend growth, triple B rated S&P credit rating. It checks all the boxes that we have here at Wide Moat Research. So Brad, you mentioned Kroger to me. I agree with you. I like it. Leading off the video today, do you have any thoughts on ticker symbol KR?
Yeah, actually, again, in a previous life when I was a developer, I've visited Cincinnati several times, which of course is where they're based. I never built stores for Kroger. Always wanted to build stores. Kroger's completed a lot of M&A activity over the years. Nothing recently, but I think in this current Trump administration, I would anticipate some more M&A in the grocery sector. Obviously, grocery profit margins are really thin. You have to really be a good operator, and you have to have those advantages of scale and cost of capital, really, if you're going to be competitive in this environment, because companies like Walmart on one end, the big chains who compete with Kroger, and then you have the dollar stores on the other end. So it's really survival of the fittest in this grocery sector, and I'm confident Kroger will survive given those scale and cost of capital advantages. So I think that's a good pick. Obviously, it's a kind of a boring pick, but I would definitely, we'll talk about Kroger rent checks here in just a minute when we get into some REITs, but I definitely like the business model for sure.
Yeah, and it's boring, but I'm looking at it over the last, where are we at here? About 20 years, this company's averaged 12.2% annualized gains. So boring doesn't have to be bad, right? That actually beats the S&P. The S&P's at 10.7% over that same period of time. So looking at the fast graphs here, $1,000 invested in the Kroger 20 years ago is at nearly $11,000 today versus a little bit over $8,000 today if you invested in the S&P 500. So that's what 2% annualized outperformance does over the long term. So yeah, this is, boring doesn't have to be bad. And that's going to maybe be the theme of this video. None of the companies I'm going to talk about are overly exciting, but they have, done very well for their shareholders over the long term. And the next one up that I'll mention has done the exact same thing as Lowe's. Home improvement centers. It has a stronger balance sheet than Kroger at BBB plus. It is more expensive though, so that's the issue here. Lowe's is trading for about 21 times. That is above its 20-year average of about 19 times. However, it's right in line, I think, with this like 5-year average. So you have to, you're not getting a discount here. The stock's done very well. It wasn't long ago. In the middle and back in June, this company was trading for 18 times. It was down at $220. Now it's up at almost $260. So Kroger's been on a big thing. Interest rates, this company's really interest rate sensitive. When rates are high, the housing market slows, construction slows down. People aren't buying new refrigerators, washers, dryers, all these big ticket items that that Lowe's sells don't happen as much when rates are high. So that's hurt the stock. However, with the Fed starting to cut rates now, we've seen this stock skyrocket. And I wouldn't be surprised to see it go higher, if the rate cutting cycle continues. That is the one issue with Kroger that you have. Oh, sorry, I keep saying Kroger, with Lowe's that you have here. This company's got the same dividend profile, about 1.9%. It's been increasing its dividend for, I think, over 60 years. So it doesn't get much more reliable than this. And as far as Buy America goes, very much like Kroger, I think 96% of this company's sales happen in the U.S. It's got a little bit of Canadian exposure, and that's it. So on one side, you can say that's great. We're focusing on America. We want to buy USA, etc. If you're into that, these are two stocks that you should love. But two, they also have a lot of international growth potential should their management teams ever decide to sort of take market share in emerging markets elsewhere. So Lowe's is interesting to me. It is very closely tied to the housing market and to interest rates, which is, kind of a bummer. I think the stock doesn't always trade where its fundamentals are, but it has wonderful dividend growth and also a very strong buyback. This company's been reducing its share count significantly for years and years and years. That's what they're all about. So the growth isn't fast here, mid single digits, typically speaking. There has been some great years in the last decade, but that's slowing down now. But looking at the chart here, once again, over the last 20 years, we're at 13% annualized growth from Lowe's versus that 10.7 for the S&P 500. So another boring company, one that you might not think is an outperformer, but it is because of its very strong business model. And unlike many retailers I'm going to talk about in a second, this company has been pretty well isolated from the Amazonization, from the e-commerce trends. People buy all sorts of knickknacks, clothes, etc., shoes off of Amazon, but nobody's buying, a new dishwasher off of Amazon, or at least, not in mass. So these home improvement stores have kind of carved out a niche for themselves doing that, selling lumber, selling plants and shrubs, etc. So if you're worried about e-commerce, like I am, this is an area where I think you're safe from that trend. So Brad, any thoughts on Lowe's?
Yeah, Lowe's is also a great company. Also Carolina based. I'm in South Carolina. Of course, Lowe's is headquartered in North Carolina. Great company. And Lowe's does appear on the balance sheets of both net lease REITs like Agree Realty and some of the others we're going to be talking about here in just a minute. So definitely a very high quality tenant. I never built for Lowe's. I always wanted to build for Lowe's, but definitely glad to have that Lowe's exposure in some of these REIT portfolios.
Yeah. So, and I guess really quickly, one thing too, Lowe's I said to 21 times. I'm going to throw up a kind of a mantra of fast grabs here. Home Depot's at 27 times. So yes, Home Depot's got a stronger balance sheet. Yes, it's got a little bit higher dividend yield. Yes, historically its growth has been slightly higher, but there's no way that it deserves that amount of premium. That's over a 25% premium compared to Lowe's. So I think that kind of valuation mismatch makes Lowe's much more attractive than Home Depot. And that kind of valuation issue is the issue I had when Brad told me to look at retailers. When I'm looking at all the top names, Costco, a huge Charlie Munger pick. This company has been soaring over the last 20 years here. I mean, you're getting tech-like performance. This company is compounded at 18.7 times. That's turned $1,000 into $31,000 over the last 30 years. So it doesn't get much better than Costco in terms of past performance. The problem is shares are trading for 50 times earnings right now. I mean, that's insane. That's cybersecurity, AI type multiples on just a retailer, right? Sure, they charge you a subscription fee. That's great, but I don't understand why Costco trades for this high. So as much as I would love to own this stock, I can't do it. I see you trying to talk, Brad. What are your thoughts on that valuation?
No, I'm just agreeing with you, Nick. I think Moat, the Costco definitely has a moat advantage. There's a wide moat with Costco, and that's why the shares are trading at a premium. Like you said, sticky investment, high switching costs, great cost of capital, scale. I mean, they check all the boxes in terms of how we rate different companies in their moat. So I like Costco a lot.
Yeah, if Costco ever sells off, I'll refinance my house and buy a ton of shares. I would love to own that company. I've been saying this for 15 years. And then if I would have just bought it 15 years ago, I'd probably have a much bigger house today. So I guess, that's my fault. But there's several other stores that are in the same boat though. Casey's General Stores, a big Midwestern chain, kind of gas station, food market, pizza joint combined. People love them in the Midwest. If you ever travel there, they're all over the place. People say that their pizza's to die for. They've gone up 3x in the last few years, but shares are trading at 36 times. So I'm not willing to pay 36 times, for what with all due respect, for like a glorified gas station, right? I love this business. Once again, I would love to own Casey's, but they're growing at 12 to 14%. So as solid as that growth is, I love reliable double-digit growth. I can't pay 35 times for Casey's. You could pay, 25 times for Booking.com and get 15% growth. So it just doesn't make sense to me on a relative basis. I don't have to own a gas station company, I'll go where the fundamentals make sense. Same thing goes for Walmart. We talked about that earlier. The largest retailer. Amazon may have passed them. I'm not sure. They're either first or second in terms of retail sales. They are the largest food, merchant in the U.S. now. They're trading for 40 times earnings. Once again, they're growing at 4% this year, and then expected to get back to double-digit growth in the next couple of years. But I can't pay 40 times. You need to be growing at like 20% consistently for me to be willing to pay that sort of multiple. And Walmart just isn't doing it. And that's their long-term average historical multiple is 18 and a half times. So historically, I think that 18 and a half makes a lot of sense. I'll pay 20% for a blue chip. I'll pay 20 times for a blue chip like Walmart, but I'm not paying 40 times. So I would have loved to have put Walmart on this list. Can't do it. And their dividend yield now is down to just 0.9%. This used to be a 3% yielder all the time. The shares have skyrocketed. The dividend growth has slowed. And I don't know what type of investor invests in Walmart anymore, because it's got growth multiples, but it's a boring company. It's very confusing to me. But anyway, wonderful company. Don't like the valuation. Avoiding Walmart. Like I said, if you want to pay 35 times for a stock forward, just go buy Amazon. They'll get you 15, 20% growth, and they're cheaper than Walmart. They're cheaper than Costco. They're cheaper than Casey's General. So to me, I don't understand it. And then you get the world's best cloud computing infrastructure on top of all their massive retail sales. So, I do own a lot of Amazon. That's the only one of these stocks that I own that I'm talking about today, but I don't even own it because of the retail component. That's just a little cherry on top. I own it because of the cloud computing business that they have. But the last stock that I'll talk about today that is very interesting compared to all these highly valued retail names that I just mentioned is Target, ticker symbol TGT. This company is only trading for 11 times. So, 1/4 the Walmart multiple, 1/2 the Lowe's multiple, 1/3 the Home Depot multiple. Yes, this comedy has struggled in recent years. Coming out of COVID, they really struggled. The tariffs have hit them hard. They've posted, their EPS in 2021 was $9.42 a share, and this year it's only expected to be $7.35. So we've seen, double-digit declines in earnings from this company. But if you believe that Target, isn't going the way of the dodo and is going to come back to life, which analysts expect to see in 2027, they're expecting 9% growth from this company. So can this management team right the ship? If they can, 11 times earnings is incredibly cheap. These shares yield 5.2%. So in the meantime, you get a really hefty dividend yield to kind of, reward your patience, to keep you, in the investment. The dividend is well covered. So dividends $4.50 a share, earnings are $7.35. It's a higher payout ratio that I'm sure this management team would like to have, but there's still a pretty good margin of safety there. So I don't think a dividend cut is in the cards here. A-rated balance sheet, very well-known brand. Everybody knows Target. The fact that Walmart is trading for 4 times the multiple of Target, to me, I think that's a pretty big disconnect in the market, and I find that interesting. Just a few years ago, this company was trading for $250 a share. Now it's at $87. So I'm not a big, deep value investor. I prefer reliable growth. You're definitely talking about a turnaround story here, but if this company turns around, it's got 100% upside. And just to get back to its long-term historical average of like 16 times. So, Brad, what are your thoughts on Target? Do you think it can turn around? And I think you have like a way that this management team can do it, right, with their real estate that you would suggest to kind of unlock a lot of value.
Yeah, for sure. I mean, Target does own a lot of their real estate locations. And of course, those are assets that are on their balance sheet. They're just sitting there. They're not really working for the company. And, on Friday last week, my daughter, who writes for the Wall Street Journal, she actually wrote a really good article, kind of breaking news article, breaking story on Six Flags. Now, she had covered Six Flags in the past, and I have too. And there's an activist out there by the name of Land and Buildings is the name of the activist, Jonathan Litt. And he is trying to get Six Flags to spin off the real estate. In fact, actually, I wrote about this today. You can see this article at widemoatdaily.com. Just visit widemoatresearch.com and you can learn all about Six Flags and what we're thinking there. But Six Flags does own a lot of real estate. And much like Target, they can use that real estate by spinning off or selling, really not spinning, but selling their properties. Now, you could spin, Target could spin their real estate into a REIT, but it's not tax-free anymore. That loophole changed, and I wrote about that in this article that I just referenced today. But there is some really good opportunities there, and of course, look, I think the you mentioned Amazon earlier, Nick, and I like Amazon too. But look, we it's now proven these retailers have to have the omni-channel. That's that's e-commerce, that's typical stores, and to certain retailers, it also includes outlet locations. So to kind of give you that full distribution for all these customer choices. And so I think Target's done a pretty good job with their e-commerce. So is Walmart, you mentioned earlier. Most of these retailers, in fact, these successful retailers who are going to survive and thrive over the next decade or two are going to have to continue to exploit all levers of this omni-channel, both e-commerce, again, brick and mortar, traditional brick and mortar, and potentially these outlet or discount locations. So Target's a great retailer. They do own a lot of real estate. I do think there could be a really interesting opportunity unfolding, much like Six Flags is doing right now, and to really continue to scale their business model.
So what's the idea? They sell the real estate to a REIT, for instance, with agreements to lease it back to them. And then they use all that capital to expand the business elsewhere. Is that kind of at a broad level what you would suggest?
Yeah, that's it. And actually, it could be a REIT. There are some really good quality REITs that have that cost of capital and that scale, but there are also quite a few private equity funds now entering the space, companies like Blackstone and KKR and Starwood and others. So I think you've seen a lot of this private capital really enter the net lease space. So I think that could really be opportunistic for a lot of these companies like Target who hold these assets on their balance sheet.
Yeah. Yeah, well, it makes sense. Like I said, so if Target could somehow, they do anything to ignite growth, the multiple expands back to where it was. Yeah, there's massive upside here. And now I'll throw up one more fast grab just to show, I think this will transition to Brad's talking about one of the worst companies. I was looking at this. I don't want to pick on Macy's, but my goodness, this is an example of what happens when your business model is disrupted. This is why I'm not a huge fan of retail, because this could happen to anybody. Brad's going to talk about why this happened to Macy's and what he's doing to avoid these types of just catastrophes in the future. But there's so much red on this screen. This is a great American company. For years they were a great dividend growth company, but now they've cut the dividend several times. They can't grow their earnings. And so this is what just people need to be aware of. You can't just buy the brands. You have to follow the fundamentals, and you have to make sure that you're looking for moats within the industry. Macy's had a moat maybe 20 years ago. Today, I would say they don't. So here's the Macy's chart, the terrible growth. And Brad, what are REITs doing to kind of avoid this type of, these struggles? Because they certainly don't want to have tenants that have fundamentals that look like this.
Sure. Well, actually, even last week I wrote on Sears, which is a great example of a company that had a tremendous moat, but then they started to expand in these other categories. I mean, many people don't know that Sears once owned Allstate and Coldwell Banker and many other companies, more of a conglomerate. I actually wrote a paper in college about Sears called "They Sell Stocks and They Sell Socks," and that's true. I mean, Sears at one point you could buy stocks from Sears. You could buy Dean Witter, by the way, is their other company they own, or you could buy socks. And so Sears obviously has evolved. COVID was a accelerator of store closures for Sears, and ultimately the company only has a handful of locations left. They could have held on, and if you read my article at Wide Moat Research, you can see exactly why they could have held on if they would have made some changes. So we're going to dive into the real estate side of it now, the REIT side. But before we get into this, I want to show you a picture. This is actually the very first shopping center that I ever developed. I don't know when this was. I think it was maybe 1990 some odd. I was building stores for Blockbuster, and this is a picture of a little small shopping center in Coleman, Alabama, a little small town just north of Birmingham, long drive from where I'm located. And I bought a piece of property. I built an Advanced Auto Parts store. By the way, that is one of our top picks at Wide Moat Confidential. We picked Advanced Auto several months ago, and shares are up over close to 100%. We took all our chips off the table. So we're planning on how, if you're a subscriber to the product, Advanced Auto, you're playing on house money right now. So Advanced Auto is a great small cap pick. And I know that company intimately. I built many, many stores for them. But this is a location in Coleman, Alabama. It was originally a Blockbuster Video. Of course, they're gone. It was originally a Payless Shoes. They're gone now. And there's a Papa John's. And that's the only company left in that little small shopping center. But the reason I built this small shopping center was I was trying to buy a 2-acre parcel of land, or excuse me, a 1-acre parcel. And the guy wouldn't sell me just an acre. He wanted the whole 2 acres. So I bought it all and built a shopping center. And the rest is history. And I ended up building for many of the bigger names, like you mentioned, Walmart and some others. So I know the space pretty well. And the great thing about investing in shopping centers is you have better investment spreads than you do on net lease. Because typically the shopping center REITs that I'm going to talk about here in just a second, they're very high quality anchor location. Most of these companies I'm going to talk about are grocery anchored. And I really like that business model because those companies, grocery stores, generate a lot more foot traffic on a regular basis. People have to go to the grocery store every week, which puts all that traffic in the parking lot weekly, which certainly supports the other retailers that are in the shopping centers. Now, the shopping center sector is pretty large. It's about $134 billion. I'm going to show you a picture. This is the entire shopping center sector. There's 14 shopping center REITs, $134 billion in total market cap. Or excuse me, that includes the shopping centers and the malls combined, $134 billion in market capitalization. The largest you can see is Simon Property Group, which is about $60 billion in market cap. We're going to talk about Simon in a second. Also, this is a performance chart looking at all the major property sectors or food groups, as I like to call them. Since 1994, the shopping center REIT sector has returned an average of 10.5%. That's annually, while the mall sector has returned 14.3%. So that's fairly decent in terms of overall performance over those many period that period of time. Now, of course, in 2019 and 2020, we saw the entire retail market just die, literally. And so people weren't going into shopping centers. People were staying at home. So you can see here, this is a chart showing the shopping center and mall performance from 2017 to 2024. Now, during that time, they actually did fairly well. But you can see coming out of in COVID, shopping centers sold off about 27%, almost 28%. And the malls just got destroyed. That was the worst performing property sector during COVID at 37%, negative 37%. But look at the rebound. In 2021, malls bounced back. 92% was the top performing property sector. And then shopping centers also bounced back, the second best performance at 65%. So definitely we've seen a continued improvements in the retail space, which is one of the reasons I wanted to focus on retail today. Also within the M&A activity, we've seen a number of retail REITs consolidate. More recently, Retail Opportunity Investment. We covered that company, $3.7 billion. I actually suggested the company was going to be acquired, and they actually did. Right after we wrote about Retail Opportunity Investment Corp, Blackstone bought the company for $3.7 billion. Weingarten is another company, $4 billion, acquired by Kimco. Erstadt Biddle, another small cap, $1.4 billion acquisition by Regency. And of course, Taubman Centers, which is a mall REIT, was acquired and merged with Simon, $3.4 billion during COVID. Now, here's the performance of all of the retail REITs going back to 2020, really over the last 5 years, plus we put year to date. You can see actually Mall REIT CBL, which is not on our buy list today. If you saw the track record of CBL, you would understand, but they actually have performed the best year to date. You can see Simon in there as well. So the mall REITs have definitely bounced back. Now, I'm going to move right into 3 picks really quickly here. First pick, and these are in no order of what I like best or worst. I like them all. Federal Realty is a shopping center REIT that owns 102 open-air properties, 27 million square feet of commercial space, and 3,000 residential units. So they evolved from a shopping center pure play into more of a mixed-use developer, and that's what they do. They do a lot of development. You can see the breakdown of the shopping center business model. I used to build grocery-anchored centers, but you can see they have mixed-use centers, grocery-anchored centers, power centers, which are typically about 250 to 300,000 square feet, anchored by those companies like Home Depot or Lowe's, and then have a very small sliver of lifestyle centers. In terms of their tenancy, they've got a lot of the big names you know out there in the retail world. They've got TJ Maxx, Ahold, which is a parent company based in the Netherlands. I used to build for one of their subsidiaries called Bilo, Gap, CVS, Ross, and Albertsons, and many others. They've got office tenants in there as well, as you can see. Now, what really differentiates Federal Realty from many of the other retail REITs is demographics. And in fact, that's one thing I'm going to focus on really here today is I think these three REITs all have some of the best demographics or household income levels compared to the peers. Federal Realty's household income level is $166,000 on average. That's one of the best income levels, as well as the population. They have about 171,000 people on average within a 3-mile radius. This is this shows you the map, general area, number of states they're located in. So these are all in very densely populated markets. Now, another key differentiator for Federal Realty is the balance sheet. The company has $1.5 billion in liquidity. And again, they have a pretty strong development pipeline. They're currently underway in building 3,200 residential units and 7 million square feet of active major rezonings are in progress. They've got an investment grade rating, so very good investment grade, triple B plus rating from S&P, of course, a Baa1 with Moody's, which is a comparable rating. And they've got very good credit metrics, 4.5 debt to EBITDA and 4.0 fixed charge coverage. Now, I pulled up this chart here. I like to put this on some of these REIT shows. This is showing the earnings, which is the blue line is the earnings or AFFO per share, and then the orange line is the orange line is the AFFO per share, which is earnings, and the blue line is the dividend. Now you can see here they didn't cut the dividend, even though during COVID you can see that orange line dip down. That's basically no rent, not a whole lot of rent coming in during 2020. They dipped back up. So they clawed back out of the COVID period. You can see very clearly. But what they did not do is they did not cut that dividend. In fact, the most impressive thing about this company is the fact that they have increased dividends for 50 years in a row, actually 57 years in a row of dividend growth. So that makes them a dividend king. Any company that increases at 50 years or greater on a regular basis is a dividend king. Now, valuation is very good. You can see here in the fast graphs, Federal Realty is trading at 18.9 times compared to their normal valuation of 25.3 times. The dividend yield is 4.5%, again, well covered by their earnings. And they've got analyst growth estimates of 7% this year and 6% in 26 and 7% in 27. So when you put the sum of those parts together, we're forecasting the company could return around 20% on an annualized basis based upon the 4.5% yield, 6% growth, and some modest price appreciation of around 10%. Now, next company I'm going to dive into is Regency Centers. I like Regency a lot. This is a Jacksonville, Florida-based company. They own 480 properties, of which 85% of these are grocery anchored in 20 different, very strong markets. I put a picture here I want to show you. This is a parking lot of one of their locations, and you can see there's not a space left in the parking lot. I don't think there's a handicap space. There is no space left in this parking lot. That's from a developer's perspective. That is what you want to see. You want to see those cars in that parking lot, because it's not only going to mean profitability for that store on a unit level economics basis, but it's also going to mean the surrounding tenants are going to see that traffic and also do very, very well in these shopping centers. You can see here also, this is a list of all the grocery chains. So they've got a large number of grocery stores. They're right there in Publix country. Publix is one of their top customers. And we just talked about Kroger. Kroger is also a top customer. HEB, which is one of the big Texas grocery chains. A number of other grocery stores. Also, you can see geographically, they're pretty well spread up and down the East Coast, the West Coast, and also into Texas. And they have a lot of development activity underway. That's why they've been able to generate pretty solid growth and really peer leading growth. Now, very similar to Federal Realty, they've got a very strong balance sheet, A- rated by S&P and A3 with Moody's. So very strong balance sheet, solid credit metrics. So when you in the company, I want to show you now, this is the earnings/dividend chart I referenced earlier. So the orange line again is the AFFO or the earnings. Again, you can see a dip. Now, they did cut the dividend in 2008 and 2009. That was the Great Recession, of course, and modestly. But since then, they've been able to claw it back, and they've increased the dividend. They increased it during COVID. Again, but they also their earnings fell off, obviously, during COVID. But they had a really good recovery. Regency's not as cheap today. Shares are trading at 19.5 times. compared with the normal valuation of 22 times. I do think Regency is definitely worth buying. I would also say you could perhaps wait for a pullback, or what I call, you may want to nibble on those shares today and wait for a more aggressive pullback if it happens. But again, I don't think you're crazy buying this company today. They've got a really attractive valuation. I think the dividend yield is something in the 3.9%. Analysts are forecasting 9% growth. So again, you take the sum of those parts, this company could generate somewhere around 15%, 10 to 15% annualized returns over 12 months. Now, my last pick is a company you may have never heard of. We've covered the company, but not extensively. So to prepare for this show, I researched Urban Edge. Urban Edge was formed after spinning off from a company called Vornado, which was more of a diversified REIT and now has become focused just on New York office. So Urban Edge spun out of Vornado back in 2015. The current Urban Edge portfolio was 72 properties concentrated in DC to Boston along that corridor. Again, very densely populated markets. In fact, I think this is probably, in terms of demographics, this company probably has the best demographics. Their average 3-mile population density is over 200,000 people. So that's got to be the highest count you see in the retail space. Also, 80% of these properties are grocery anchored. 15% are leased to value-oriented grocery anchors, and 5% are leased to home improvement chains like Lowe's that we talked about earlier. They have a potent mix of grocers in the portfolio that generate around an average of $900 per square feet. That is amazing sales they generate with these locations. Again, driven by demographics. You can see here the top tenants include companies like TJ Maxx, Burlington, Kohl's, Best Buy, Home Depot, Lowe's, Walmart, PetSmart, Target, and Whole Foods. So very strong portfolio. Again, I mentioned the key differentiator for this company is population density. That's the demand driver that we see here. You can see this chart. I pull this. In the first ring New York City suburbs, there's the population growth and actually has increased 5% during COVID. So people are staying more at home and going to the grocery store typically every single week. Look at this map, and this shows the density of where these shopping centers are located. So also they've undergone a lot of repositioning and a lot of redevelopment over the years. So that's also going to help create more of a stable revenue stream for the company. So I like Urban Edge there. Liquidity is actually very strong too, $900 million of liquidity. Very good debt metrics as well. This is the earnings and dividend chart. Again, I'll refer to that I did with the previous two. You can see here the company's not that old, but again, they did fall off. That's the orange line, AFFO per share during COVID, like all retail REITs did. They also did cut the dividend. But what I like about that company, if you look at the far right of the chart, you can see the upper orange, which is the earnings and the dividend growth, and there's a wide margin of safety. So they've got a really good payout ratio, just under 70%. Analysts are forecasting growth around 9% in 2026 and 2027. So when you combine those three factors, you can see that the company's trading at 18.9 times versus 21.7 times. So there's definitely some multiple expansion there. We think Urban Edge could generate around 20% on an annualized basis. So if we're going to pick one of these three, I like Urban Edge a lot. It's cheap. It's got a lot more growth opportunity ahead. I like these markets. But frankly, Nick, all of these REITs that I mentioned are in densely populated markets. I think that's the key. And that's something I learned as a developer. And I built in a lot of these small towns. And honestly, when I drive by shopping centers like the one in Colvin, Alabama that I showed you earlier, I would never build anything like that today. I really only want to own retail real estate in densely populated markets like the ones we talked about here.
Does Regency or Urban Edge, do they do mixed use stuff as well? Because to me, that's kind of what sets FRT apart. I love that live, work, play mindset they have. Grocery stores drive foot traffic, but so do apartment complexes. So do they do that, or is FRT kind of unique in that regard?
Yeah, I think FRT is more unique. Now, remember, Simon, I could have included Simon on this list in the mall sector. Simon has definitely evolved into more of a mixed-use developer, taking a lot of these older department stores and converting them into other, less traditional locations, hotels, apartments, et cetera. And Federal's done the same thing. They have definitely diversified their product offering, as you will. Regency is just a pure play grocery REIT, mostly grocery anchored, and so is Urban Edge. And I would not be surprised to see some combination. Again, we've seen a lot of M&A activity. I mean, Urban Edge definitely, to me, when I started researching this company, appears to be a potential M&A target. And I would not be surprised if a company like Regency swooped in to buy Urban Edge. That could definitely happen in this environment.
Well, a lot of upside for Urban Edge shareholders in that regard. And yeah, we talk about scale all the time, so it makes sense to me. So yeah, I think we covered probably about 10, 15 companies today. I hope you guys like this video. I think we're about 40 minutes, a little long for us, but that's okay. Please comment below. You guys have requested retail. Well, here you are. Here's our retail special. If there's any other sectors or industries you would like for Brad and I to cover, please let us know. We're always in the comments section, and please like and subscribe to the video. All that stuff helps with the algorithm and helps motivate us to keep making these videos for you guys.
Great. Thank you, everyone. Look forward to seeing you next week. Drop some comments below, and I look forward to seeing you then.
Thank you for tuning in to this week's episode of the Wide Moat Show here on YouTube. If you enjoyed our content, please like and subscribe to our channel and leave a comment. We'll be sure to get back to you ASAP. Also, please sign up for the Wide Moat Daily. That's our free daily newsletter at widemoatdaily.com. That's where you'll find Brad and I's insights on all sorts of things published every day in the evening. So thank you guys for stopping by, and we'll see you next week. Happy Swan investing.